Et bonjour tout le monde. Good morning, everyone. My name is Paul Bodicher. I'm the Director of Media Relations here at the Bank of Canada. I'll be moderating this press conference about today's interest rate announcement and the publication of our monetary policy report. Le gouverneur Macklem va prononcer une déclaration préliminaire et après on va tourner aux questions. After his opening statement, Governor Macklem and Senior Deputy Governor Carolyn Rogers will be happy to take your questions. So at this point, I will turn it over to Governor Macklem for his opening remarks. À vous la parole.
Thank you and good morning. I'm very pleased to be here with Senior Deputy Governor Carolyn Rogers to discuss today's policy announcement and our monetary policy report. Today, we raised our policy interest rate by 25 basis points to 5%. We are also continuing our policy of quantitative tightening. This decision reflects two broad considerations. First, monetary policy is working, but underlying inflationary pressures are proving more stubborn. We have made considerable progress in the fight against inflation. CPI inflation has fallen from a peak of 8.1% last summer to 3.4% in May. But even as headline inflation has come down largely as we forecast, underlying inflationary pressures are proving more persistent than we expected. Higher interest rates are needed to slow the growth of demand in the economy and relieve price pressures. Second, we are trying to balance the risks of under and over tightening monetary policy. If we don't do enough now, we'll likely have to do even more later. But if we do too much, we risk making economic conditions unnecessarily painful for everybody. We've come a long way, and we don't want to squander the progress we've made. We need to stay the course to restore price stability for Canadians. Cette décision reflète deux grandes considérations. Premièrement, on a fait beaucoup de progrès dans la lutte contre l'inflation. La politique monétaire fonctionne. L'inflation mesurée par l'indice des prix à la consommation est passée d'un sommet de 8,1% l'été dernier à 3,4% en mai. Mais même si cette baisse est généralement conforme à nos prévisions, les pressions inflationnistes sont plus persistantes que prévu. Il faut des taux d'intérêt plus élevés pour ralentir la croissance de la demande et alléger les pressions sur les prix. Deuxièmement, on tente de bien doser notre resserrement monétaire. Si on n'a fait pas assez maintenant, il faudra probablement en faire encore plus par la suite. Et si on en fait trop, on risque de créer une situation économique inutilement difficile pour tout le monde. Il ne faut pas que nos progrès ne servent à rien. C'est pourquoi on doit garder le cap si on veut rétablir la stabilité des prix pour la population canadienne. Laissez-moi vous expliquer ces considérations et quelques points clés des délibérations du Conseil de direction. Depuis le début de l'année, la croissance mondiale a été plus forte que prévu. La baisse des prix de l'énergie et du taux d'augmentation des prix des biens ont aidé à ralentir l'inflation dans le monde. Mais il y a encore des pressions inflationnistes dans le secteur des services. Elles sont alimentées par la demande robuste et les tensions sur le marché du travail. On estime que la croissance économique mondiale en 2023 va dépasser nos prévisions de janvier et d'avril. It's a similar story in Canada. Growth has been surprisingly strong and the economy remains in excess demand. Consumer spending on services remains robust. And while spending on many goods that are typically sensitive to interest rates has slowed, it has not slowed by as much as we expected. The housing market has also seen some pickup in activity.
which we will strictly observe.
Several factors
The
appear
chair
to
would
be
further
supporting household
announce to
spending.
committee
The
members
labor market
the
remains
chair's
tight,
intention
even if there are
is
some
in the
signs of
second week we
easing.
return in July,
The unemployment
we'll
rate
have a
has
markup,
increased slightly,
and that markup will
but remains
include
historically
two
low,
important
and wage
bills.
growth has been
One
between 4% and
is
5%,
giving digital assets a
higher
market
than what is
structure and
consistent
federal
with
regulatory
price stability.
remit, And the second
Many
is a federal
households also
stablecoin
accumulated savings
regime.
since the beginning of the
It is the
pandemic.
intention of the chair to
Some
have that
households have
as
cut back on spending
two
because
pieces of
inflation
our committee
and higher
markup
interest rates have
in the
eaten into
second
their
week we
budgets,
return in July.
and some are being severely squeezed.
I now recognize myself for
But
4
for
minutes to
many,
give an opening
larger
statement.
savings may
Thank
be
you,
acting as
Chairman
a buffer
Powell,
and supporting
for joining us
consumer
today.
spending.
Inflation remains broad-based and persistent.
Rapid population
Two troubling
growth is
trends the Fed
contributing to both
expects will
supply
continue.
and demand
As you
in the
said
economy.
last week, the process of
Newcomers
getting
to
inflation
Canada
back to
are entering
2%
the
is
labor
a long
force,
way to
easing
go.
labor shortages.
So even though the Federal
But at the
Open
same
Market
time,
Committee
they add to
did
consumer
not recommend a
spending
rate
and the
increase at
demand for
last
housing.
week's meeting, it's fair to say
Turning
that the
to
Fed
inflation,
will continue to make additional
while
increases
CPI
in the
inflation
months
has
ahead.
fallen
We'd like to
relatively
hear
quickly,
your thinking
much
on
of the
those
downward
matters.
momentum has
As
come
the
from lower
FOMC
energy
again
prices
pointed
and
out last
base year
week, the
effects,
labor market
as large price
still appears
increases
tight.
we saw
With
last
Fed
year
policymakers
fall out of
projecting
annual inflation.
a rise in an unemployment rate to
We
a
are
still
still seeing
low
large price
4.1%
increases in
at the
a
end of the
wide
year.
range of goods
Despite
and
pressure
services.
from the left,
Our
the Federal
measures of
Reserve
core
must
inflation,
remain
which we
committed
use to gauge
eliminating
underlying
this
inflationary
stealth
pressures,
tax on
have
American
come
workers
down,
and families.
but not
And I
by as
urge
much
you
as
to
we
continue
expected.
that
3 months
resolve.
rates of core inflation
A few weeks
have been
ago,
around
Congress took the
3.5
first
to
step
4%
toward getting our fiscal
since
house
last
in order
September,
through the Fiscal
suggesting little
Responsibility
downward
Act.
momentum in
Republicans
inflation.
will continue
Consumer
fighting
and
for
business
sensible spending
expectations for
reductions to
near-term
combat
inflation are
inflation.
moderating, but
This
they're
stands in
still
stark
high.
contrast to Democrats'
And
spending spree
businesses
that
are
poured
saying
nearly
they are
$2
still
trillion
increasing their prices
into a
more frequently
supply-constrained
than they did
economy
before the
that was
pandemic.
already flush with trillions of
Looking
savings
ahead,
provided by
we
earlier
continue to
bipartisan
expect
COVID
economic
rescue
growth
efforts.
to moderate
And after
inflation
keeping
to
interest
ease.
rates too low for
But
too
this
long,
will
the
take
Fed
longer
was
than
slow
we
to address
forecast
the
in
problem.
January and April.
In a stunning about-face,
As
the
the
Fed
global
then
economy
raised
slows
interest
and
rates
higher
by
interest
5
rates work
percentage
their way
points
through the
in a
Canadian
little
economy,
over
we
a year,
expect economic
the
growth
fastest spike
to average
in
about
modern history.
1% through
This
the
approach
second half
introduced
of this year and
accelerated
the
interest
first
rate
half
risk
of
for
next
which
year.
companies, workers, and
This
families
means the economy moves into
across the
modest
country
excess
were
supply
not
in early
prepared.
2024.
The bank runs we saw
and this
earlier
should
this year are an
relieve
example
price
of the consequences.
CPI
Now, we're
inflation
told
is
these
forecast
runs
to
represent a
remain about
systemic
3%
threat
for
to
the next
stability of our
year
financial
before
system.
declining
Add in
gradually
the
to the
commercial real estate
2%
exposure
target
facing
in the
financial
middle of
institutions,
2025.
and it becomes very easy to
This is
understand the
about
mounting
6
anxiety
months later
consumers
than we
and job
expected in
creators
April.
share. And I share
Our
their
decision to raise the
anxiety
policy
as
rate
well.
reflected the
The
persistence in
rapid
both
rise in
excess
interest rates,
demand
coupled
and
with
underlying
knock-on effects,
inflationary
the bank
pressures,
failures have led
combined with
to
our
signs of a
outlook
credit
for
crunch across
economic
the economy.
activity and inflation.
This would have a damaging impact
The consensus
on
among the governing
consumers
council
and job
was
creators
that
alike.
monetary policy needed
To top
to
it
be more
off,
restrictive
Vice Chair for
to
Supervision
bring
Michael Barr is
inflation
undergoing
back
a
to the
so-called
2%
holistic
target.
review of capital requirements.
These
And
decisions are
something
difficult, and
interesting
we
that
did
he
discuss
mentioned
the
in the press
possibility
even
of holding
yesterday,
rates unchanged and
is
gathering more
is a new
information to
approach
confirm the need to
stress
raise the
tests,
policy rate.
that
On
I
balance,
can't
our
quite
assessment was the
understand.
cost of delaying
If reports
action
are accurate,
was
he's
larger than the
pursuing a
benefit
massive
of
increase in
waiting.
capital standards for medium and large
Elevated
institutions.
inflation is a burden on Canadians,
This would limit
especially
banks'
the most
ability to lend
vulnerable.
money, exacerbating the looming
We are also
credit crunch
acutely
and
aware
starving
that higher
families and
interest
small
rates are
businesses of the
making
capital they
life more
need.
difficult for many
Financial
Canadians.
markets will also bear this strain
And
as
we
they
know
will be forced to
many
absorb
Canadians
nearly
are
$1
asking,
trillion in new
is the Bank of
treasuries.
Canada done
This has
raising
led many
interest
to
rates,
believe
or
the
will
Fed
rates
may
need
be
to go
called on to
still
help,
higher
perhaps
to
through its
relieve
repo or other
inflationary
facilities.
pressures?
Clearly, our economy is
The
in
short
a
answer
precarious
is we will be
position,
taking
from
each
inflation to a
decision
potential
based
credit
on the
crunch to
available
substantial balance
information
sheet
at the
risks
time.
for financial institutions.
What
There's
we
a great
can
deal of
say
uncertainty
is that
on the
monetary
horizon.
policy is working, and we know it
Uncertainty
will
from
take
Fed
more time for the full
supervision
effects
and
of
regulation
past interest
is
rate
the last
increases to
thing
work
the
their way through the
well-capitalized
economy.
banking system needs
With the
now.
increases in our policy
Following
rate in
numerous
June and
supervisory
July,
failures
our outlook
and a
has
new vice chair
inflation
for
going
supervision at the Federal
back
Reserve
gradually
injecting
to the 2%
politics
target.
into policy,
But several
it's become
things need
clear
to
that
happen for
Congress may
inflation to
need
continue
to
easing.
again
And we are
examine
particularly
separating
concerned about
supervision
two
and
upside
regulation
risks to the
out of the
outlook.
Fed
First,
and gaining greater
we have been
oversight
surprised
and
by the
control
persistence
by
of
Congress,
excess demand
in the
and
elected
underlying
branches.
inflation in Canada
With that,
and globally.
Mr. Chair, thank you
We
for
know
being
that
here
higher
today.
interest rates are
And
having
the
an
chair now
impact,
recognizes
but
the
how
ranking
big their
member of the full
impact will
committee,
be
the
is
gentleman from
uncertain.
California, for 4 minutes for
Second,
opening statement.
with the
Thank
downward
you,
momentum in
Chairman
inflation
McHenry.
waning and our forecast suggesting
Chairman Powell,
inflation will be
welcome
around
back.
3%
First, I'd
for the
like to
next
start
year,
by acknowledging
we are
that the Federal
concerned
Reserve
that the
made
progress
the right
to price
decision
stability
to
could
pause
stall,
interest rate
and
hikes.
inflation could
As
even
you
rise
know,
again
since
if
last
there are
November,
upside
I've cautioned
surprises.
against
As I
any
said,
approach to monetary
we are trying to
policy
balance
that
the risks
ignores
of
the
over and
Fed's
under tightening.
maximum
If new
employment
information
mandate
suggests we
and
need to do
results
more,
in a
we
recession
are
with
prepared
millions
to
of
increase
people
our policy
losing their
rate
homes and
further.
jobs.
But we
While we have
don't
had
want to do
strong job
any more
growth
than we
thus
have to.
far, experts contend
These decisions will
that
be
this
guided
trend
by our
will not
assessment of
persist.
incoming data and the outlook for inflation. We need to see demand grow slow, wage pressures moderate, and corporate pricing behavior normalize. We will also need to see near-term inflation expectations and measures of core inflation come down further. Avec les hausses du taux directeur de juin et juillet, on prévoit un retour graduel à la cible de 2 %. Mais plusieurs choses doivent se produire pour que l'inflation continue de baisser. On est préoccupé par le risque que le retour à la stabilité des prix puisse stagner. Et l'inflation pourrait même remonter s'il y a des surprises à la hausse. Comme je l'ai dit, on tente de bien doser notre resserrement monétaire. Si des nouvelles données indiquent qu'il faut en faire plus, on est prêt à relever encore le taux directeur. Mais on ne veut pas en faire plus que nécessaire. Nos décisions vont être guidées par notre évaluation des nouvelles données et les perspectives d'inflation. Il faut que la croissance de la demande ralentisse, que les pressions sur les salaires se modèrent et que les entreprises reviennent à leur pratique de fixation des prix habituels. Il faut aussi que les attentes d'inflation à court terme et les mesures de l'inflation fondamentale descendent encore. Let me conclude. The substantial drop in inflation over the past year is welcome news for Canadians. But monetary policy still has work to do. Our job is not done until inflation is centered on our 2% target. That's the level that helps the economy grow sustainably, restores competitive forces in the economy, and gives Canadians the price stability they need to budget and invest with confidence. And with that, Summary, the Senior Deputy Governor and I will be very pleased to take your questions. Thank you.
Thank you, Governor. Let me quickly go through the housekeeping and we'll get to your questions. We do have a number of reporters here in Ottawa at the bank, as well as some on the phones. We're going to start here in the room before going to the phones. I will ask everyone to limit yourself to one question, please, just to give every outlet the opportunity to participate. If I forget to do so, please state your name and affiliation. And I'll remind people on the phone to please only unmute your line to ask a question and then go back on mute as soon as you're finished. That way everyone can hear both your question and the answer. It's the *6 button on your phone that toggles you between mute and unmute. Pour mettre votre ligne en mode discussion, appuyez sur étoile 6 et pour enlever, faites étoile 6 encore une fois. Avant de poser une question, veuillez vous identifier et comme toujours, libre de poser vos questions dans la langue officielle de votre choix. Okay, so with that, let's go to our first question here in Ottawa, and I'm going to call on Steve Shearer from Reuters, please.
Chair McHenry to join us in advancing.
Hi, Governor. Thanks for talking to us today. I'm a bit torn as to which question to ask.
I yield back.
Let me ask this one. A few months ago,
Mr. Barr,
in January, you paused rates, and when you did, you indicated that it would be a pause. And since then, we've seen the housing market recover.
That could increase capital
and
for
you said
financial
today in the
institutions as
statement
much
that
as
it's adding to
20%.
inflation.
Our
Do you
already
think that
well-capitalized
it was a
banks
mistake
withstood the
in your
COVID shock and
messaging
severe
in January
Fed
to
stress
say
tests
that?
as the
Should you
economy is
not
facing
have
headwinds
maybe
from the Fed's
just
own
said,
rapid rate hikes?
we're
Now
not
is not
raising
the
rates
time
today,
to be
but we're
engineering
gonna keep
massive
watching
new
things?
regulatory changes or hindering
Let me
regional
just
banks,
remind you
which
what
have
we said
already
in
been
January,
under
what the
stress.
situation was.